Welcome to Building a Decentralized Economy, the perspective on cryptocurrency from an equity investor of 25 years. My name is Emmy Sobieski. I'm a CFA, which is a chartered financial analyst focused on equities, and a certified Bitcoin professional. I ran the #1 fund in the world, riding the wave of the internet, of 497%, called the Nicholas Applegate Global Tech Fund. I've been an institutional investor for 25 years. I was the former VP of platform expansion at CoinCloud, America's largest cryptocurrency ATM network. I'm an investor in a crypto hedge fund and have invested in crypto since 2017. The crypto movement is to get rid of centralization. The original idea of the ARPANET, if any of our cities went down because of a nuclear attack, the military would still be able to communicate among themselves across the country. No single point of failure. It's distributed. Decentralized, you can still have places that you meet, such as we do on Discord and Telegram, without saying, everyone is only going to meet on Facebook, and if Facebook decides to cancel you, you can't meet. And so decentralized is somewhere in between. Some parts of crypto are fully distributed, but others where you want to transact with someone, you do need to meet in order to do the transaction. There is this balance. Go as distributed as possible as long as it makes sense. Here's the way that I looked at how we're building a decentralized economy. The original idea behind Bitcoin was coming up with some kind of a way to transact that was not under the control of a centralized government. This came after the 2008 meltdown of the economy and markets, with people questioning whether control over our economy and our financial future should be under one government or another. That was the beginning. There had been previous digital currencies, but nothing had gained the kind of traction that Bitcoin has. Then Ethereum came out with smart contracts. Can we agree to things in a software program so that we don't have to come back after the contract and pretend that we didn't agree to it? We put money in the smart contract, and if things happen the way we agreed to, then the money gets paid. It takes away source of friction. DeFi is, can we encourage people to come together that are interested in earning and trading with the same currencies? Then NFTs, non-fungible tokens, are tied to art. Can we get paid to create? And the final piece of Web3 and creating this decentralized economy is identity. The original internet didn't have an identity layer. This did allow a lot of nefarious activity to take place on the internet. Back to Bitcoin and financial instruments. Doing business with someone that you don't know, you wouldn't have any reason to trust them without a letter of credit. This can be international remittances. This can be just buying pizza. It could be big or it can be small. The idea is trustless systems. That's a little bit of a misnomer because you do have to trust in the system. You have to trust in the blockchain. Bitcoin uses something called mining. All these computers around the world compete to come up with the answer to a question of what is this very large prime number. Once you guess that large number, you get rewarded with Bitcoin. It's so hard. A different computer will win it every time. The ones that are verifying the last, say, 10 or 20 transactions will be a different computer. The authority of saying, yes, those were the transactions is completely distributed because it will be a different authority around the world each time. In practice, you have some concentration of these computers logically where the price of electricity is lower. Ethereum started on mining and they're moving more towards staking. I stake 32 ETH, so $100,000 depending on the price of ETH. If enough people say that my verification was fraudulent of the next transactions, I can lose $100,000. So I'm motivated highly to be ethical about what I am verifying. That's how transactions are verified. Then if you can trust this system, you can send money to buy things, you can trade these cryptocurrencies with other people peer-to-peer. Now you can transact, but how about agreeing to something and not having it be on paper where you're going to later argue about it? Decrease that friction and agree to something up front. That is Ethereum. You set it and forget it. If you write the software really well, the contract is final. And you reduce the friction of coming back later and bickering or trying to renegotiate. Paint a room in my house. We agree how that paint's going to look. And maybe we pick a third party that's going to come over and check out the house. The third party can be involved in the smart contract too. We put the $500 for the paint job in the smart contract. The painter finishes the job. I take a picture of the job. We're both happy with it. The third party comes in and verifies, yep, the job was done correctly. And then the painter automatically gets paid. It does create a way to come to agreement in software. There was a decentralized autonomous organization where you vote how you want the money invested. Somebody figured out you could work with the code and get it to send money to that person. It was not hacking, it was working with that smart contract and getting it to pay this person $50 million. The challenge with smart contracts is this is software code. If it's written the wrong way, it can do the wrong thing. Now earning. Back to some of the early ways and compare it with where we are now. DeFi is called decentralized finance. One of my friend's husbands, Will Warren, created 0x. You could trade Bitcoin, Ethereum, you could trade all these cryptocurrencies, and it was decentralized. It wasn't a centralized exchange like Coinbase. You could trade peer-to-peer, person to person. The problem was that there wasn't enough volume or liquidity. I would show up and want to trade my Bitcoin for Stellar, and someone else would show up and want to trade their Ethereum for a different coin. That's great that we're both here, but we don't want to trade the same things. This industry is full of impressive innovators. They came up with this idea of a liquidity pool. This pool is for people who want to earn interest on Ethereum and they're getting paid Bitcoin to put Ethereum in a pool. It may be wrapped Bitcoin that can go on the Ethereum network, but that's overcomplicated things. How is this not centralized? Think back to distributed versus decentralized versus centralized. You still have multiple pools, and the central authority becomes the smart contract. If you go by the terms of the smart contract, then you will earn the money in these pools. Some of the pools are created by less stellar teams, so you have to take that into account because this is financial transactions. The worry of a centralized authority. You have some trades on and you're doing well, and then Robinhood comes along and maybe doesn't benefit them or the people that pay them well, which is the hedge fund Citadel, for the stock that you're in to go up anymore. They can stop you from trading in that stock. That's what happened early in 2021. Maybe they had problems with their own liquidity. Maybe they didn't. We don't really know. In a DeFi, you're all entering into a smart contract. The negative is there are certain ratios that are in that smart contract. Say you're earning Bitcoin on Ethereum or some other combination, and your Ethereum moves in one direction and the other one moves in another, and now your ratio is off in terms of the assets that you need to put into that smart contract. The smart contract will stop you out and maybe get you out right at a low point in Ethereum where that doesn't benefit you. That is the risk. Now we can transact, we can agree to things, we can earn money in a decentralized way. What about the creators? That is non-fungible tokens. A non-fungible token is tying a token to a unique asset. Why do we call these tokens not shares? The origin of the tokens in cryptography is a token is a way to open up a lock. Now they're used more broadly like a share, but it's not, because a share relates to equities. Then there's fungible and non-fungible tokens. Consider Bitcoin, where one Bitcoin is fairly the same as the next, the same with Ethereum, except that some of the newly minted can have a premium value because you don't have to look at who has owned it and if it's been in the wrong hands. In general, those are all fungible. One Bitcoin's the same as the next. When you buy Bitcoin, you just buy Bitcoin. Non-fungible token is tied to a unique asset. One NFT is not the same as the next. It can be tied to real estate, tied to a digital photo, tied to a physical photo. These things feel like they just come along all of a sudden. In late 2020 and early 21, NFTs were all the rage. Where did this come from? Back in 2017, CryptoKitties was one of the original NFTs. People were breeding digital cats. The high-end ones went for hundreds of thousands of dollars, especially if it was the first generation cat. CryptoKitties used up 25% of the Ethereum network and nearly took it down. There were people working all night and trying to keep the throughput. And so these things come slowly and then suddenly. They've been around for a while and developing. Why now? OpenSea and other platforms allowed you to create NFTs in a much easier way and then interact with your audience. On NFTs, it seems this is art and has nothing to do with securities. Anytime that you have something where you're benefiting from the work of others and you expect a return, it can be judged as a security. Watch the language people are using in NFTs. Owning NFTs, where you love the artist and you want to be tied to them, is great. Crossing the line is buy this NFT because it's going to go up by 100%. The final piece is identity. If you can transact, agree, earn, create, and then you can identify who you're talking to when you want to, but not all the time, you have Web3. Internet 1.0, you were anonymous. You could say who you were, but you might not be truthful. The early internet was the purview of quite a few different criminal organizations. There is a benefit to knowing someone's identity. But why would we have that here in Web3 when we call it a trustless system? When we're buying, agreeing, earning, creating, there are times where you want to share a piece of your identity. You want to authenticate your art. You want to authenticate yourself. And there are other times where you want to keep your privacy. You want to do business with people who are not criminals and respect their privacy. The answer is not Web 2, where Facebook or Google verifies you and you're putting your identity in the hand of some company. That's not the answer. You are the person that would know your own identity, self-sovereign identity. A lot of this can be done by biometrics. Zero-knowledge proofs allows you to have privacy plus transparency. In a simplified example, if I'm going to a bar and the bouncer says, I need to see your ID. Now I'm showing him my home address, weight, full age, eye color. All he needs to know is that I'm over 21. If I had a zero knowledge proof, I show him I can unlock a lock. That zero knowledge proof knows that I'm over 21. All the bouncer sees is that if I've unlocked that combination, I'm over 21 and he lets me in. That's this idea of keeping privacy, transparency in terms of knowing if someone is a criminal or not, and allowing regulators to protect us by keeping chunks of identity separate, which is called sharding, where no one piece would identify and link to a person. Then you can combine them later if you have a valid inquiry from a regulator. That's what I see coming with identity. You can be private when you want to. You control what you share, when you share it, because it's self-sovereign identity using biometrics and zero knowledge proofs. You are safer because you don't show your anti-money laundering and know your customer to everyone, but when it's needed, it can be provided.